Welcome to this video, where we will be discussing the Silicon Valley Bank collapse, one of the most significant bank crises in the United States. In this video, we will dive into the causes of the collapse, its impact on the U.S. economy, and the lessons learned from this catastrophic event. Silicon Valley Bank was a major financial institution that was established in Santa Clara, California in 1983, with a mission to provide financing to the technology and innovation industries. The bank was highly successful and became one of the largest lenders to startups in the United States. By the late 1990s, the bank had expanded its operations to other parts of the country, with offices in Boston, New York, and Seattle. However, the bank's rapid growth and aggressive lending practices eventually led it to its downfall. During the dot-com boom of the late 90s, Silicon Valley Bank provided loans to numerous tech startups that were later found to be unprofitable. The bank's portfolio was heavily concentrated in the technology industry, and when the tech bubble burst in 2001, the bank was left with significant losses. In addition to its exposure to the tech industry, Silicon Valley Bank also made risky investments in the commercial real estate market. The bank's real estate portfolio suffered significant losses during the housing market collapse of the late 2000s, which contributed to its eventual collapse. The collapse of Silicon Valley Bank had far-reaching consequences for the U.S. economy. The bank's failure led to a significant loss of investor confidence in the banking sector, and other financial institutions also faced significant losses. The federal government was forced to step in to provide a bailout to stabilize the banking sector and prevent a larger financial crisis. The collapse of Silicon Valley Bank also had a profound impact on the technology industry. Many startups that had relied on the bank's financing were forced to shut down or seek alternative funding sources. The collapse of Silicon Valley Bank also contributed to a decline in venture capital investment in the technology industry, which had a ripple effect of innovation and economic growth in the United States. To delve further into the collapse of Silicon Valley Bank, it is worth noting that the bank's troubles were not just confined to its lending practices. The bank also faced allegations of fraud and misconduct, with several senior executives being accused of misleading investors and regulators about the bank's financial health. In 2010, the Securities and Exchange Commission, SEC, brought charges against 3 former executives of Silicon Valley Bank, accusing them of securities fraud and other violations. The SEC alleged that the executives had concealed the bank's deteriorating financial condition from investors and regulators and had engaged in improper accounting practices to hide losses. The case against the executives was eventually settled, with the former CEO of Silicon Valley Bank, Kenneth Wilcox, agreeing to pay a $150,000 fine and to be barred from serving as an officer or director of a publicly traded company for 5 years. 2 other former executives also settled, paying smaller fines and agreeing to be suspended from practicing as accountants or auditors. The allegations of fraud and misconduct at Silicon Valley Bank underscore the need for stronger corporate governance and accountability in the banking sector. Finally, institutions must be held to the highest standards of transparency and ethical conduct, and executives who engage in fraud or misconduct must be held accountable for their actions. The collapse of Silicon Valley Bank provides several important lessons for the banking industry and policymakers. First, it underscores the importance of diversification in banking portfolios. Concentrating too heavily in one industry or asset class can lead to significant losses in the event of an economic downturn. Second, it highlights the need for stronger regulation and oversight of the banking industry. The failure of Silicon Valley Bank was in part due to lax lending standards and risky investment practices. Stronger regulatory oversight could help prevent similar collapses in the future. Finally, the collapse of Silicon Valley Bank also underscores the importance of transparency and accountability in the banking sector. Finance institutions must be held accountable for their actions, and regulators must have the tools and resources to effectively monitor and regulate the banking industry. In conclusion, the collapse of Silicon Valley Bank was a catastrophic event that had significant consequences for the U.S. economy and the technology industry. While the lessons learned from this event have been painful, they are essential for preventing similar collapses in the future. As we move forward, it is crucial that the policymakers and the banking industry learn from their mistakes of the past and work together to build a more stable and sustainable financial system for the future. Thank you for watching this video on the Silicon Valley Bank collapse. We hope you found it informative and thought-provoking. If you have any comments or questions, please feel free to leave them in the comments section below.